Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth-building strategy, so you can stop worrying about your 9-to-5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. I am here today to, maybe bring a somber note to real estate investing. I think today's episode, we're going to talk about the pitfalls of property ownership. And so I think what we'll find is obviously everything that I've taught up until this point, the first 29 episodes of the podcast, we've been preaching about the great benefits, and we've talked a little bit about the bad pieces as well. But I wanted to do an entire episode on maybe all the things that you should be prepared for in real estate ownership and property ownership. And so that's what today's episode is about. But I don't want it to discourage you from diversifying and investing in a real estate portfolio, because ultimately, from a return standpoint, from a financial standpoint, it's one of the best investments that you can make. So I want to talk about a couple of things. And we have I guess the way I want to break it down is I want to break it down into two categories, which are things that are within your control and things that are not within your control. And so I want to start with, we'll start with the things that are, and there's some things that fall in between there, but we'll talk about those. So let's talk about the things, first of all, that are not within your control. So first of all, one of the pitfalls of real estate investing, especially over time, is the ever-changing housing laws, landlord, tenant protection laws, and things that are implemented not just on a federal basis, but on a state, maybe even a county or a city-wide basis. You've got different laws and different bylaws and covenant-controlled communities. So there's literally different laws and different rules on all the way from the federal level all the way down to like a super local, hyper local, neighborhood level. And so the first pitfall is either one, your lack of knowledge of these laws that can get you into trouble if you don't follow them or you don't follow the local covenants. And secondly would be just trying to stay up with them. If you've got properties in different parts of the nation, if you've got properties in different parts of the state, different counties, different cities, different neighborhoods, it is very important that you keep up with these, again, ever-changing laws and regulations that come down on landlords. So 2 episodes ago, episode 28 of the podcast, we talked about the new laws that are being implemented here in Colorado, or that already have been implemented here in Colorado, regarding tenants and landlords, things like the radon disclosure that needs to be disclosed to all people in the property, and may cause you to need to put radon mitigation in the properties or have a property that's considered uninhabitable. We talked about accepting applications and the limitations on pet fees that you can have. So there's a lot of different stuff that we visit when we're talking about the law changes. And in addition to that, like I said, sometimes these change on a federal level and on a local level. So if you've got properties all throughout the United States, for example, it is important that you stay up on those law changes throughout. So ever-changing housing laws, I think, is pitfall number one. And we are moving more and more, depends on the state that you live in, but at least here in Colorado, those laws are getting more and more tenant friendly. And there's a threshold at some point that I think they get so tenant friendly that landlords won't want to even own real estate in Colorado. And unfortunately, the problem with that will be that it will actually hurt renters more than help them. So all these laws that are put into place to protect tenants will ultimately drive landlords out of the market, and then there won't be any rentals, and there won't be people that are willing to rent. So one of those things right now is happening with pet laws. The first we didn't really have a huge restriction on pet laws prior. Obviously, if you have some type of service animal, that isn't considered a pet. It's like an extension of the human being. But if you have an emotional support animal, for example, that emotional support animal can no longer be charged monthly pet rent, can't be charged a deposit. And as we all know, or as many of us know, we can go online and get an ESA certificate for our animal friend, our pet friend, pretty easily and for very inexpensive. And so people have already begun to take advantage of that to save themselves pet fees. Now, in addition to that, local community and local law here in Colorado has changed the amount of not only pet deposit, but also the monthly pet rent fee that can be charged to your tenants. And so as this happens, more and more landlords are just going to resort to not allowing pets at all. And so the only bypass to that would be a true service animal, because again, a service animal is not even considered a pet. It is an extension of the human being, much as a pair of crutches or a walker or a wheelchair would be considered. And so that would be the only exception to not having a pet in the property. ESA animals are still considered pets, even though they're emotional support. So those ones could be, not accepted, and you would not be in violation of a fair housing guideline. So anyway, what we'll see more and more people just not allowing pets, and then it's going to be really difficult to find a renter or find a property that's going to rent to you if you own a pet. And that is spurred from a law that is supposed to help tenants not be charged for pets. So it's kind of a catch-22, and I know it's going to put people who have pets kind of between a rock and a hard place, and that's really unfortunate. But that's where those laws are coming from. So anyway, number one, ever-changing housing laws. Number two, high interest rates. Okay, high interest rates could be a pitfall, but it could also be helpful. As interest rates get higher and higher, it drives people out of the housing market. If people are driven out of the housing market, they have to be in the rental market. So if there's more people in the rental market, it causes more demand and it increases our rent rates. So we could look at that as a positive piece, but it's only a positive piece if, as a landlord or as a property owner, you already own property. If you're trying to go out and purchase your first rental, it may make it more difficult. You may not be able to, qualify from a debt to income standpoint. You may not be able to afford the property. There's all kinds of different things. Like I said, in Colorado now, we are not even a cash flow state. You're going to be cash flow neutral at best right now, with a big down payment on a residential rental property. So high interest rates, although again, kind of a double-edged sword, can help the rental market. It really only helps you if you're an existing landlord, because again, if you're trying to go out and buy something, it also makes it really, really difficult, especially because during high interest rate markets, generally the investment or the non-owner occupied interest rates are substantially worse, because investors are less willing to take that risk, because it's already high risk to own, a high interest note, that it's easier to default on a higher interest note, obviously, than it is on a low interest note. So anyway, I think that could be a pitfall, again, if you don't already own property. So the next piece is vacancy. Vacancy just in general, in all scopes of rental real estate, whether it be commercial or residential. Vacancy is a short-term deal killer. It is something that I tell people: don't overprice your properties when you put them on the market, because let's say you've got a property that rents for $3,000 per month, and you try to put it up for even $3,100. That's extra $100. If you just have 12 days of vacancy, right? Because the difference between $3,100 and $3,000 over a year, which is the duration of a lease, is only $1,200. So at $100 per month, okay, difference, 12 days essentially of vacancy or so. You've got essentially at $3,000 per month, it's $100 a day in rent. So after 12 days of vacancy, you will have eaten up your entire year's gains of trying to get $3,100. And 12 days of vacancy is nothing, right? So if you're overpriced, you're easily going to have 20 to 30 days of vacancy, no problem, because you're going to have to wait, first of all, for that price for you to price drop it. And then once you price drop it, then maybe you get a tenant that's willing to move in at the start of the next month. So overpricing a property is hugely detrimental to you, because you're not just losing, quote unquote, like $100 per month by not getting 3,100. You're losing the entirety of the rent payment. And so, especially if you're leveraged, if you've got a mortgage payment of 2,500 and you're trying to get 3,000 a month in rent, and you go vacant for a month, you just lost $2,500 that wasn't covered by somebody. And just that extra $100 alone, it would take you 2 years to make that up. So price your properties accordingly, price your properties correctly to make sure that you get rented quickly and don't have vacancies, right? So I see that a lot with new purchases. When people go out and buy a rental, and it's a brand new rental, when it's already been rented, there's already a tenant in it. We have a little bit of a better understanding of what that property will rent for. But sometimes we get a little bit overzealous when we're purchasing a brand new property, and we're like, oh, maybe it rents for $3,000 a month, but maybe we can get 3,100. Yeah, maybe you can, but is it worth the vacancy to find out? In my opinion, the answer is no. So those are like the big three that are kind of, again, I suppose that the first two are definitely things that are out of your control. The high interest rates, the ever-changing housing laws are completely out of your control. Vacancy is something that is partly within your control. So I want to do one other one that is partly within your control, and that's bad tenants. Obviously, bad tenants can ruin an experience as a landlord. In fact, I know a lot of people that don't want to be landlords because they don't want, maybe they did it once in their life and they had a terrible experience with tenants. So a couple things I'll say to that. First of all, if you're doing your due diligence on the front end, and if you're a good read of character, a lot of times you can eliminate that. You can eliminate the possibility of having, I shouldn't say eliminate, but you could minimize the possibility of having a bad tenant, right? So good screening reports up front, making sure you're having really good conversation with these people. And in my opinion, managing your own properties, or at least placing your own tenants, and then letting someone manage it after the fact. But I want to know who's in my property. I want to get that read of good character. That's really important to me. The second piece behind that is just knowing, what type of property you're renting. I mean, if you go out and buy an 8-plex of 1 bed, 1 bath in a dumpy area because there's great cash flow, just think about the turnover and the type of tenant that you're going to have. It's going to pay $1,100 or $1,200 per month in rent. I'm looking for people that have the qualifications and the ability to rent a $3,000 per month property, which means they've got a good income. They probably get a good enough job. If you have a good enough job, you probably have good enough character to keep that job. So there's some things that kind of add up to make sure you get good tenants. So bad tenants, while it won't always be your fault. A lot of times that you contributed to the fact that they're not the greatest tenant around. So the next one, we're going to start getting into the what I call the landlord traps. Okay, and so the landlord traps, I have a list of them, and this is, I don't know, I suppose sometimes you could look at these as good things, but I think they're all bad things. So the first one is the shiny penny effect. The shiny penny effect is the effect that is essentially people not keeping their blinders on and running the course, slow and steady, right? And so the idea here is it's when we come up with a game plan, a financial game plan to go in one direction, and our eyes, we catch that shiny penny off to the side that's like, oh, hey, invest in these new, great, beautiful mountain homes, for example. They're going to be absolute, killers. And what happens is everybody and their mother would be buying them if the returns were as good as they said they were. And we're kind of trying to take that chance, right? So we see it with people trying to go into short-term rentals, for example. So they take their long-term rental mentality and they push it over into the short-term rentals. And short-term rentals are a completely different business. First of all, they take a whole different level of management and care. And secondly, there's a lot more risk there. When you sign a 12-month lease, it's kind of a set it and forget it for the next 12 months. With a short-term, You don't know when your next payment's coming in. And the reality is the only place where, in fact, I found people that are buying homes in vacation destinations for short-term rentals are actually doing worse than people who are buying, you know, homes just like in the suburbs and running short-term rentals out of them. So the reality is like we see this mentality, and I get clients all the time. We talked about this on the podcast before, but I get clients all the time that say, you know, hey, I'd love to buy a home in Breckenridge, or I'd love to buy a home in Naples, Florida, and you know, as long as I could break even with the rentals and I could use it a couple times a year, like that would be fantastic. And I my response to that is always kind of like, yeah, that would be fantastic. Everybody would do that. If everybody could have like 3 or 4 free trips to Naples every year, and on an ever appreciating piece of real estate at no cost, they would absolutely do that. Right. So the reality is, if it sounds too good to be true, it probably is. And it's just not that easy. It's not as easy as being like, oh, I'm going to buy a place and I'm going to short-term rental it, and I'm going to stay there whenever I want and have Christmases in Breckenridge and or Christmases in Naples and you know, Labor Day in Breckenridge or whatever it may be, and think that you're going to break even or make some money. So anyway, it's kind of that shiny penny effect. They see something that they think is better, and people don't stay the course, right? So the next kind of landlord trap is actually the opposite of one of the earlier ones, which was bad tenants. The landlord trap is really good tenants. This becomes really problematic. If you have really good tenants, a lot of times what happens as a landlord is you don't want to stir the pot. And so every year you come up and you renew your lease and you go, you know, hey, you guys have been such good tenants, I'm not raising my rent. And after 10 years, you're 50% back on your market rate of what you should be on rent. And then all of a sudden what happens is maybe you run into a financial situation where you need to sell the property. You run into a financial situation where maybe you need to raise the rent. Well, I don't know a whole lot of people that can absorb a 100%. If you're 50% behind market rent, you would need to double the rent in order to get to market rent. I don't know a whole lot of people that could absorb 100% increase in rental rates. So that means your tenant, first of all, they're not going to renew. They're not going to be able to afford that. Where if you would have just made really small incremental increases, you know, over the last 10 years, they'd probably be fine and they'd probably still be renting from you. But first of all, they're not going to be able to absorb that cost. The second piece is they're in lease. So if you're looking to sell the property and you got 6 months left on the lease, you can sell the property if you want. But whoever the new purchaser is going to have to abide by that lease. They can't just go in and terminate that lease. So first of all, if there's 6 months left on the lease, you can't sell that property to an owner-occupied person. So you're going to remove like 95% of your buyer pool. If it's a single-family residence, for example, nobody who's going to live there can buy it. The only people that can buy it are investors. And I don't know how many investors you know, but I don't know a whole lot of investors that are willing to buy a property at market price when the market rents are 50% of what they should be, because they're going to take a huge loss on the property from a market rent standpoint for the next, 6 months until they can get somebody else in there. So are they going to be willing to buy the property? Sure, but they're going to pay for it properly. They're going to go, you know what? I'm losing $1,000 a month for the next 6 months in order to do this. I got a cost of money, and it's not worth the risk. So I want a $25,000 discount on the property. So you're going to lose $25,000 upon resale because you didn't keep the rents up to date. So the second piece is with really good tenants is we tend to, if they're really good tenants and we don't raise their rents, then the tenants tend to justify the fact that the property is not properly cared for, right? So if you were constantly increasing rents and your tenant might come in and say, hey, if you're going to increase rent, it's time to get new carpet in here, or it's time to get new floors, or it's time to get out here and fix that refrigerator that hasn't been working right for the last year. Like, otherwise we're not going to pay an increase in rent. So what happens is tenants, as much as the landlord doesn't want to stir the pot with the tenants because they're really good tenants, the tenants don't want to stir the pot with the landlord. So if they know they're paying significantly under rent or under market rent, they're not going to ask you for repairs on the property. They're just going to let the property get into disrepair because it's worth it to them to have, for example, really nasty carpets, because they're paying $1,000 a month less than monthly rent calls for it in the current market. So it's really important that when we have really good tenants, we maintain the course and understand that we're running a business here, right? So maybe you give some sort of great incentive, or maybe you send them a Christmas gift every year or something like that, that shows your appreciation for them being good tenants. But just because a person comes to your coffee shop every week for the last 10 years doesn't mean you give them half price coffee every time they come in, right? You appreciate their support. But you have a business to run, right? And so you can't give them the coffee at a loss. You have to continue to charge those prices, and maybe you give that person a punch card because they're there and they get every 10th coffee free and they get a slight decrease. It's one thing to be charging 5 or 10% under market rent because you have a really good tenant. It's another thing to be half of market rent. Okay, so. So that kind of ties in with the next piece, the landlord trap, which is not maintaining the property. And a lot of times that comes from having a really good tenant, or just a tenant that, even if they're not a really good tenant, a tenant that continues to re-sign their lease and they're there for 10 years. And the reason you keep re-signing the lease is because, again, they don't really bug you. They don't call you for anything. Well, the reason they're not calling you for anything is because they're not fixing anything. There's nothing, they don't want to stir the pot either, right? So when it comes to selling the property, you could take a hit of tens of thousands or even hundreds of thousands of dollars because you deferred maintenance over so many years, okay? We already briefly talked about this one. It kind of goes along with the shiny penny effect, but it's buying something for personal use and investing. I really believe that those two things should be kept separate. I'm a huge believer in not mixing your personal and your business, because there's a couple of things that happens with that. First, we talked about a couple of them already, but if you're buying something for personal use, buy it for personal use, right? And be okay with knowing that you're going to have to make a monthly payment on something that maybe you only use a couple of times a year, and be okay with that. If you want to rent it out in between, fine. Just know that it's not a good investment. You bought it because the personal use is what's important to you. Don't buy them as both. There's going to be a couple of things that happen with that. One, every time you're going to want to use it for personal use, it's going to be rented. And then you're going to be like, well, why do we buy this thing if we're never going to use it, right? Two, the times when you want to use it most are the times when you're going to get the most amount of money. You're like, oh man, we should go spend Christmas or New Year's in the mountains this year at our mountain property. Well, yeah, that's when you make $1,000 a night on your property. It's when you make, 20% of your entire year on your mountain property. So are you going to go use it? No. It doesn't make any sense to do that. So now what are you doing? You're sacrificing the personal use time, which is what you kind of bought the property for in the first place. And I think the last thing for me is I notice that when people buy a property for personal use, even if they're renting it, what ends up happening is anytime they go on vacation, they end up saying, well, let's go to our property in Breckenridge, or let's go to our property in Florida or something like that, because you almost feel bad not using it, because you're like, well, I bought it to use it. And then you end up vacationing in the same spot. My recommendation would be buy it for investment use only. And whatever money you make on the investment side, use that to go on vacation to somewhere different each time, right? Even if you have a property in Breck and you want to go to Breck, fine. Take the money that you're gaining from your property for that week and use it to rent another property in Breck. And the reason to do that is a couple of things. When you're buying for personal / investment use, you're going to let emotion take over almost every time, and you're going to buy more because of the personal want versus the investment want. And those are two very different things. Okay, a property that is good for an investment may not be great for your personal use, and vice versa, right? And it rarely is. Something that's good for your personal use is probably not going to be the best investment that you can make in that area, right? So you're going to sacrifice on one or the other. So I'm a big believer in just keep your stuff separate. And I speak that from experience. I have a property that we use for personal use and investing. We love it for personal use. It's a terrible investment. Long term, I'm sure it'll be great because of appreciation and things like that. But it's a cash black hole. And so I'm speaking from experience with that. And again, it's because we bought it more on the personal side than we did on the investment side. Okay. The next piece is the next landlord trap is probably renting to friends or family. It can sometimes be good, but I think it rarely works out. And there are so many. Most of the horror stories that come from landlords are when they rent to a friend or a family member, and it becomes because again you're running a business. It's almost like hiring your friend or a family member. When a friend or a family member works for you, it is really difficult to separate your business from your personal. Okay, they mess up at the job. It's hard to fire them because you're their friend and you know their personal life and they're not going to be able to pay their bills. Okay. Even worse is doing both, hiring your roommate, right? So you hire your roommate and they're a terrible employee. You know that if you fire them, you're not going to get rent paid that month, right? So like the people kind of almost make a double dip and end up having problems on both sides. So I think renting to friends and family, like be very careful with that, because what it does is it'll put you in, even if they are really good tenants, okay, it'll put you in that landlord trap of the really good tenant trap, which is you're going to have a hard time raising rent on your family member or your friends because A, they're your family and your friends, and B, they're taking really good care of your property. So then you get yourself in that secondary landlord trap of not charging what you should. All right. So anyway, these are the things to think about. I think these are the things a lot of times people don't think about when they're getting into this. They see the returns, they see the money, but I think it's also important to play devil's advocate and look at this side and say, hey, are you ready to treat this as a business? And I think as long as you can, I think if you can conceptualize and visualize your real estate portfolio or whatever your real estate goals are, if you can put it in terms of this is me owning a business, you can eliminate almost everything that we talked about on this list. Because everything that we talked about on this list comes from some sort of personal decision. But if you owned a business, right? If you owned a business, think about anything else, like I said, a coffee shop, or you own a gas station or whatever, right? You know that your number one killer is vacancy, or in this case, in a coffee shop would be no customers. So what would you have to do if you didn't have any customers? You would immediately improve your marketing efforts and lower your price, right? You would start going out and giving free samples of your coffee, because if you believed in your business, you believed in your product, you would get out and put your product in front of people. So you would go to the fair and you'd give away free coffee and say, come to our coffee shop and get a buy one, get one, right? You would do whatever it takes to get people in the property, in the business, right? Your bad tenants are like your bad customers, right? Would you have bad customers if you continue to have these bad customers over and over and over again? No, you would make a change. You would figure out, maybe I just need to be in a better location, or maybe I need to change my product. You would get away from whatever was bringing your bad customers in, right? So all of these things, think about it. If you can think about it from a business standpoint and not from a personal standpoint, you can eliminate almost all of these pitfalls. So I hope that was helpful. I hope that it gives you a different perspective about the things in real estate that we look for, and some of the negatives that we might have, and how they can be overcome. And that, to me, again, is just run it like a business, right? So hope you guys learned something from this, and that it was enlightening and maybe eye-opening to the fact that most of these things are controllable, and if you do things the right way, there's not too much to worry about, because in the end, it's always worth owning real estate. So take these tips and tricks and implement them into your current portfolio, or keep them in the back of your mind for any future portfolio, so that you can buy some real estate, make some money, and live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.